Welcome to the Pro Ticker Deep Dive.
It's good to be here.
I think we have to start by, I don't know, circling the date on the calendar in red marker or something. Friday, January 30, 2026.
Yeah.
Because if you were watching the terminal today, or, just nervously checking your portfolio app, you probably felt a serious case of financial whiplash.
Whiplash is probably the polite way of putting it. It really felt like the market tried to digest about 3 months worth of news in a single trading session. It was messy.
Incredibly messy. We had this just deluge of conflicting signals. We wake up to inflation data that, let's be honest, nobody wanted to see.
Right.
Then by lunchtime, the entire leadership of the Federal Reserve is basically upended. And if that wasn't enough, you look at the board and it makes absolutely no sense. Big tech is splitting apart. Bitcoin is flashing these huge warning signs. And gold just gets crushed.
It looks like total chaos on the surface.
Right.
But, and this is our job today, we have to clean up that picture because it's not random noise. There is a very strict, almost brutal logic to what happened today.
And that is the mission. We're going to connect these dots for you. We need to figure out why that whole inflation is dead narrative just took a massive hit.
A huge hit.
What Kevin Warsh taking over the Fed actually means for your money, and why the so-called safe havens just completely failed when we needed them.
It all comes down to a reality check. I think the market has been pricing in, well, perfection. A smooth landing, easy money, everything just going up and to the right.
Yeah.
Friday was the day the market realized that the path forward is going to be a lot bumpier and maybe much steeper than anyone thought.
Okay, so let's start with the spark that lit the fuse this morning. The Producer Price Index, or PPI. Now, usually PPI is the boring data point. It's the wholesale number. Economists look at it, but normal people don't really care. They care about CPI.
Right, but they're paying at the store.
But today, PPI was the main event.
It absolutely was, and for good reason. You have to think of PPI as a kind of crystal ball for the Consumer Price Index. It's the pipeline.
Right.
If prices go up for the producer, the factory, the wholesaler, those costs, they eventually get passed on to you. And the numbers for December 2025 were hot.
Okay, how hot are we talking? Give us the context.
Well, the consensus on Wall Street, they were looking for a nice, sleepy 0.2% increase month over month.
That's the goal. Stable.
That's what you want. Instead, we got 0.5%.
So more than double what was expected. That's not a rounding error. That's a significant miss.
It's huge. And it gets a lot worse when you peel back the layers and you look at the core data.
Okay.
If you strip out the volatile stuff, food and energy, you get to core PPI. It jumped 0.7%. That is the sharpest spike we've seen since July. So year over year, core inflation is now accelerating to 3.3%.
Which completely, it just contradicts the story we've all been telling ourselves for 6 months, which is that inflation is trending down nicely to 2% and we can relax.
Exactly. We aren't gliding down. It looks like we're bouncing back up.
Yeah.
And this is where the details get really interesting because the source of this inflation isn't what it used to be.
Right, because I was looking at the breakdown and the goods sector, it seems fine. I saw diesel fuel prices collapse down almost 15%. Beef prices are down. So if the raw materials and the fuel to move them are getting cheaper, where on earth is the inflation coming from?
And that is the critical insight for today. You're absolutely right. The stuff, the commodities, they're behaving. The problem is the services around the stuff, specifically wholesaling margins.
Wholesaling margins. So the middleman is just taking a bigger cut.
Precisely. We saw a 4.5% surge in margins for machinery and equipment wholesaling. So the companies that move the goods, store the goods, and sell the goods are charging more. They feel like they have pricing power.
So to put that in real-world terms, the diesel to run the tractor is cheaper, the steel to build it might be stable, but the dealer selling you that tractor is charging way more.
That is a perfect way to visualize it. And it wasn't just machinery. We saw spikes in residential natural gas, non-ferrous metals.
Yeah.
But the sticky part, the part that keeps central bankers up at night, it's those service margins.
And why is that harder for the Fed to fight than, say, the price of oil?
Because you can't just fix it by unclogging a supply chain or drilling more oil. This is embedded pricing power. It suggests companies feel confident enough to keep raising prices. And for you listening, this matters because it just destroys that whole Fed pivot narrative.
The idea that the Fed is just going to slash rates and ride to the rescue.
Right. Think about it from their perspective. If inflation is sticky at 3.3% and it's rising, they cannot cut rates aggressively. If they do, they risk a 1970s-style inflation spiral.
Uh-huh.
So this data implies a higher-for-longer interest rate world no matter what the stock market wants.
Which is a perfect transition to the other massive piece of news that dropped, because the person who has to make those tough decisions, well, that person is about to change.
The changing of the guard, it's huge.
President Trump made it official. He's nominated Kevin Warsh to succeed Jerome Powell in May. Now, names get thrown around in Washington all the time, but Warsh is not a new face to the market.
No, not at all. He's a veteran. He served on the Fed board from 2006 to 2011. He was in the room during the Great Financial Crisis.
So he knows how the system works.
He knows where all the bodies are buried, so to speak.
Mm-hmm.
He understands the plumbing of the Fed. He's an institutionalist.
So he's not coming in to just, burn the place down.
Correct. And that is why you saw the stock market breathe this collective sigh of relief. The rumors started overnight, stocks were down. The official announcement hits, they rallied.
Because the market was scared of a wild card.
Terrified. Someone purely political who might just wreck the currency or slash rates to zero to juice the economy. Warsh is seen as competent and credible.
But he's not a clone of Jerome Powell, is he? My understanding is he has a bit of a different philosophy.
He does. Warsh has a reputation for being more hawkish.
And for those who don't speak central bank, hawkish just means he hates inflation more than he loves low interest rates, basically.
That's it, exactly. Historically, he's been very critical of easy money policies. He's warned for years that keeping rates too low for too long creates asset bubbles.
Okay.
So the expectation is that while he'll eventually support cuts, he won't be reckless. He respects the value of the dollar, and he understands the danger of inflation.
And that creates this fascinating conflict for investors, right? Because on one hand, the stock market is saying, yay, a competent guy we know.
Right.
But on the other hand, the bond market is looking at that hot inflation data we just talked about and at Warsh's record and saying, oh boy, rates are not coming down.
The bond market did not cheer, we should be clear. It panicked a little.
And we saw the 10-year Treasury yield just shoot up.
Yeah.
Pushed right up to that 4.25%, 4.27% range.
And we need to pause on that because it sounds like just a number. But the 10-year yield is like the gravity of the financial world. It sets the price for mortgages, car loans, everything.
Uh-huh.
When it spikes like that, it's the market saying, we don't care who the chair is. Inflation is sticky, so the cost of money is going up.
So the bond market is kind of the truth teller here.
Yes, it's a tightening of financial conditions happening in real time. And that tightening is starting to break things in the stock market, even if the headline numbers look kind of flat.
Let's talk about that breakage, because if you just looked at the S&P 500 at the close, you'd think, okay, choppy day, but whatever. But under the surface, it was violent.
We call this the haves and have-nots market. The divergence is just becoming extreme.
And the poster children for this split were Microsoft and Meta. I mean, two members of the Magnificent Seven, they're supposed to trade together.
You'd think so. But today, total opposites.
It was striking. You had Microsoft, maybe the safest tech stock in the world, dropping nearly 10% in one day. That's billions of dollars in market cap just gone.
And at the exact same time, Meta Facebook rallies 10%.
So what does that tell you?
It shows that investors are done blindly buying tech as just one big thing. The era of just buy the index might be pausing. People are becoming ruthless. They're looking at earnings reports with a microscope.
So what did Microsoft do wrong? Or what did Meta do right?
Well, with Microsoft, the market is punishing uncertainty. There are concerns over cloud growth, the return on their AI spending. The market's asking, you spent billions on chips, where's the profit?
And they didn't have a perfect answer.
Not a perfect one. Meta, on the other hand, just proved they are an efficiency machine. They are printing cash.
So the lesson for the listener is that selection matters again. You can't just throw a dart at the tech sector anymore.
Exactly. Capital's getting expensive. Remember that 10-year yield? When capital's expensive, investors demand results now. They won't pay for growth at any price.
And you see it in the broader picture. The S&P 500 has been stuck near 7,000 for what feels like forever. We can't seem to break through.
It has been a grind. I mean, it's been nearly 300 trading days since we crossed 6,000. That's a long time. It suggests the rocket ship phase is over. We're in a grind-it-out phase now.
But, and this is important, it's not all bad news. While big tech was fighting itself, other parts of the market were actually working.
That's right. We're seeing a rotation. While tech was volatile, small caps held up. Financials held up.
Which makes sense if yields are rising, doesn't it? Banks usually like higher interest rates.
They do, so the market is widening out. It's not just 7 stocks holding up the world anymore, which is actually a healthy sign for the long term, even if it's painful for tech investors right now.
Speaking of painful, we have to talk about the elephant in the room, the
That-
digital elephant. The crypto market got hammered
Oh,
today.
yeah. It was a sea of red.
Bitcoin down about 5%. But you flag something that goes beyond just a bad day. You mentioned a death cross.
I did. And I know these technical analysis terms can sound a bit like, voodoo or reading a horoscope to some people.
It sounds like something from a heavy metal album, not a financial chart.
It does sound dramatic. But let's just break down what it means. It's really just math. On the weekly chart, we're seeing the 20-week simple moving average cross below the 50-week simple moving average.
Okay, so the 20-week is the short-term trend, the 50-minute is the longer-term trend.
Correct. When the short-term trend falls below the long-term, it means momentum is accelerating to the downside. The wind has shifted from your back to your face.
And why is this specific crossover such a big deal?
History. In crypto, momentum is everything. There are no earnings reports to fall back on. It's all about flows. And if you look back at previous cycles, 2014, 2018, 2022, every time this weekly cross happened, it signaled the bull run was broken.
What kind of downside are we talking about in the past?
Massive. We're talking 60% drops or more, and bear markets that dragged on for hundreds of days.
Whoa. So this isn't just a casual buy the dip moment.
It's a major warning sign. It doesn't mean Bitcoin goes to zero tomorrow, but it does mean the structural trend is shifted. The path of least resistance is now down or sideways.
And it wasn't just crypto. Gold, the ultimate safe haven, fell over 5%.
Yeah.
Silver crashed nearly 18%. I mean, 18% in a day for a metal it's a liquidation event.
It was a liquidation event, absolutely.
But why? We just spent 10 minutes talking about hot inflation. Isn't gold supposed to go up when inflation is hot? That's the textbook rule.
In a textbook, yes. But in the real world, you have to factor in the dollar. And this brings us right back to Kevin Warsh and those bond yields.
Okay, connect the dots for us. Why does a hawkish Fed share hurt gold?
Okay, so hot inflation plus a credible hawkish Fed chair means interest rates are staying high. If rates are high, an investor can get 4.25% or 4.5% risk-free just by holding U.S. dollars in a bond.
Right, you get paid to hold dollars.
Exactly. Gold pays zero interest. Bitcoin pays zero interest. They just sit there. So when the return on dollars goes up, the attractiveness of those non-yielding assets goes way down.
So the dollar got stronger today on the Warsh news, and it was like a wrecking ball.
A wrecking ball against gold and crypto. That's the Warsh effect in action.
There was one asset that ignored all this, though. Oil.
Yeah, oil is dancing to a different tune. It doesn't care about the Fed right now. It cares about geopolitics, tensions with Iran, risks in the Middle East. That fear premium is keeping a floor under oil prices.
And speaking of geopolitics, we have to talk about the headline that I honestly thought was a prank when I first saw it.
The Greenland saga.
Yes. We're talking about tariffs on our NATO allies because of Greenland.
This is the definition of wildcard risk. The reports are that the administration is threatening 10% tariffs on NATO members. We're talking Denmark, the UK, France, Germany, starting February 1st.
And rising to 25% by June.
That is the threat, and it's explicitly linked to stalled negotiations over the U.S. purchasing Greenland.
I feel like I have to ask, why? Why disrupt trade with our biggest partners over an icy island?
Well, strategically, it's not just ice. It's what's under the ice. Rare earth minerals. If you want to build chips, EVs, advanced defense systems,
Yeah.
you need those minerals.
And China dominates that supply chain right now.
They do. So the U.S. views Greenland as a critical asset to secure its own supply chain for the next century.
Okay, so there's a logic to it, but for the market, this is a nightmare, isn't it?
It's an absolute nightmare. Markets hate uncertainty. If you're a German car maker, how do you plan for the next quarter? You suddenly have a 25% tax looming over your head that has nothing to do with your business.
It just throws a massive wrench into the global economy.
It does. It disrupts supply chains, raises costs, which, by the way, feeds right back into that inflation problem we started with, and it strains alliances. It adds a layer of risk to everything.
So let's pull all this together. We started by saying today felt like a perfect storm.
And I think the evidence bears that out. You have the economic reality of sticky inflation, the political reality of a new Fed chair who might keep rates high, and the geopolitical reality of trade wars coming back.
That narrative of easy money, smooth sailing, it feels officially dead.
It's broken. And that requires a mindset shift for every investor. You can't navigate 2026 using the map from 2025.
So what should we be watching next week to see where this all goes?
Two things. First, the confirmation hearings for Kevin Warsh. Watch the tone. If it looks like a circus, if senators threaten to block him, volatility will spike. The market wants certainty.
And the second thing?
Jobs data.
Yeah.
Both Chairman Powell and likely incoming Chairman Warsh have made it clear. They're watching the labor market. If the job market stays hot, combined with this inflation, rate cuts are completely off the table.
Which brings me to a final thought for you to chew on this weekend. For the last few years, we've been in this bad news is good news world, right? If the economy slowed down, we cheered because it meant the Fed would save us with cheap money.
That regime is changing.
It really feels like we're entering a period where bad news is just bad news. Sticky inflation is bad. Tariffs are bad. And with valuations where they are, I mean, we're at .com levels, aren't we?
In terms of Shiller PE ratios, yes, we are priced for perfection.
So if we're priced for perfection and the data is showing us all these cracks, are we too complacent? The market is betting on a soft landing, but the landing strip just got very, very icy.
It forces you to look at your portfolio and ask a really hard question. Do I own quality assets that can survive a storm? Or am I just surfing a wave of liquidity? Because looking at Friday, that tide might be going out.
A sobering thought, but a necessary one. Keep your eyes on the data. Ignore the noise.
And don't just blindly follow the herd. Critical thinking is the only edge you have left.
Couldn't agree more. See you all in the next Pro Ticker Deep Dive.